it's a confluence of two things. We still have a strong American economy. So if you speak to most of the CEOs, they say their order books are good, consumer balance sheets are good, the economy's growing, wages are going up, they're still hiring people, unemployment may very well hit 3.3% this year. That's all good. On the other side of it, you have a bunch of geopolitical stuff, oil, Brexit, but I think the one that's probably roiling the markets the most is trade. And the issue about trade is not just the direct effect, it's the indirect effect that how bad it's going to get, what can go wrong. And of course, that fat tail of a trade war. If you weren't even thinking about that a year ago, and now people are talking about how bad can it get. So that's why you see it's kind of swinging the market all over the place. And that, with the added thing, rates are going up, and is it recessionary? Now, I personally think the yield curve, it doesn't tell you that at all. But that's the thought, that maybe there's something in the yield curve that's telling you might have a recession. So, but what we all see in the actual facts on the ground is you still have growth in America. When you talk about the risk of the Fed doing it too much, too fast, there's also a risk of doing too little, too slow. And of course, it's easy for people who own assets today. It's all about lower rates. But the fact is, a strong economy, normalizing rates is a good thing. So, my guess is the Fed's going to be looking at data right up to the last minute, and that they probably will do December. I don't think the Fed should be overreacting because the stock market went up or down, or people are afraid of trade, or stuff like that, or possible geopolitical events. And normalize is a good thing. The world will be much happier if America's growing and rates are going up a little bit than if we have a recession and rates go down. It's better for the world. So I think they'll probably stay on course, and of course people are going to adjust their speculation on that issue. Not weakening. Car loans are being made, 17 million cars are being sold. It's humming along. I think a bunch of people have gotten a little more conservative in subprime auto. That's a very minor total effect on the United States economy. And home mortgages, mostly because rates are going up, and that the option adjusted spreads and mortgage going up a little bit, so it's a little more expensive to get a home. If I was the government, I would go out of my way to expand the credit box. Right now, we still have restricted credit to a lot of buyers because of all the mortgage origination, securitization, purchasing rules and stuff like that. And that can be fixed and doesn't create any extra risk. I think if you looked at a bubble anywhere, it would be in government bonds. Where rates have been suppressed now for the better part of 8 years. And that's the other side. That you don't want to find out that we're starting to have inflation and we have to sell. And this year the United States has to sell $1.8 trillion of bonds between the government of $1.2 trillion and the Federal Reserve so far plans to sell 600. That's a huge difference from a couple of years ago. And so that's the supply and demand is different. So I wouldn't be a buyer of government bonds at these prices. I honestly believe the 10-year should already be at 4%. And nor do I think it was at 4%. It would be a disaster if the American economy is going to 2.5 or 3.